All right, everybody, welcome to this evening's webinar. My name is Diego Mello with StratiVentures, and this webinar that we hold is an industry webinar that happens every 2 weeks, and we like to highlight companies, and we also like to make sure that the real estate community has the right information from the right people. So today we've got Julian Vasquez of the Julian Vasquez team with Altera Home Loans joining us. He's going to give us a little insight on the lending market update, which, guys, I'm definitely going to tell you that's, if not one of the hottest topics next to the weather that is out there. The webinar is officially started. We'll get started on the topic around 6:35, and then around 7:10, we'll open that to a Q&A session. For those of you that are joining us this evening, if you're new to Zoom, just remember that all questions, and I'm going to repeat that, all questions, please put those into the Q&A. And then we don't have any polls this evening. And if you needed to ask a question to the moderator that is off topic or just a generalized SVI question, go to the chat box. And if Julian becomes very, very boring with this information, feel free to leave the webinar. Just kidding, Julian. I would say that Julian and I have known each other for so long. You refinanced our house. Well, actually, you did the purchase and then you did the refinance of the house, and along with a lot of our members. So we really do trust and encourage working with you. This event is for everybody that's joining us, so we do encourage questions. And quickly, just want to let the new people know about StratiVentures. We are a full service real estate investment company established in May of 2012. And we like to basically let everybody know that we have the 4 prongs of real estate, which is the acquisition analysis, real estate services, project management services, and last but not least, funding. I know we've got some of our lenders on here because I do see some very familiar names. Rick Bressler there with Katie Capital Investments, which is one of our favorite investor private lenders to work with. And then obviously we have our traditional lending component, which is Julian with Altera. To get to know SVI and some of its members, feel free just to give us a call. Or check us out at StratiVentures.com. And here's the core team of SVI. Also, for those of you guys that are members that are joining us, this is a notice, Enid Lopez is no longer in the marketing director position. She's actually moved into the business development agent role, which she found pretty much a real knack for this. So guys, we want to congratulate her. And as those of you that have worked with her know that her personality is amazing. So I guess she's ready to start monetizing that at a higher level. And then if you wanted to know more about us and how to get a hold of us, it's at StratiVentures.com. My name is Diego Mello. I'm the founder and CEO of StratiVentures. Here's a little bit of information about myself. I literally tell people that I was born in Colombia at the age of 4, and I learned how to do things backwards, which was learning how to speak English before Spanish, learned how to dance country music before salsa and merengue. So everybody laughs at me and they're like, "You're really not Colombian." And I'm like, I'm going to stop there. I'm not even going to go there. But I do love my Colombian culture, heritage, and my family's all there. Professional background, mortgage broker and asset manager. Then I moved into investing and I founded StratiVentures in May of 2012. And now, Julian, we are happy that we're over 2,300 members, over 27 states. And as we like to tell people, it's a win-win or we don't do it, because that's the SVI model of the company. What do we tell people what StratiVentures is we are an implementation company for investors. If you are a new investor, if you're a seasoned investor, if you don't know where to start or how to engage to start scaling your business, you guys, give us a call. We're happy to work with you. And most of all is we want to share the identity of what an SVI member is that's an investor that analyzes, acts, invests, and profits with one word in mind, and that word is risk. The goal is to help mitigate risk with you first, and then with the people you work with. And then at the end of the day, you'll notice that all the deals become low risk. One of those risks is lending. Right, Julian, wouldn't you say right now that is somewhat of a pretty edgy topic around the country?
I would say extremely.
Great.
Yeah.
So you're going to share with us some of your insight. Here's a little bit that we're going to share with you about our guest speaker, Julian Vasquez. He migrated to the United States in '86, became a mortgage lender in 1998. And I will say one thing: when I stopped in the mortgage industry, um, I was thinking somebody's got to be crazy to be in the mortgage industry nowadays, and you're still moving forward. So that tells you guys that if Julian's been able to survive the ups and downs of the mortgage industry since '98, he really knows what he's doing. You merged your brokerage with Altera Homes in early 2020, and you're a student of the University of Houston, and you're a certified in the entrepreneurship from Bauer College. You also are active participant in your church in Katy, Texas, and you're married and you have two wonderful kids, which I got to meet at your grand opening of your new branch in Katy. I think it was this past week or the week before. So Julian, welcome. I'm going to go ahead and hand it off to you. And I'm going to stop the share, ladies and gentlemen. Remember, Q&A questions, if you've got them, we'll be able to answer those closer towards the end.
Thank you so much, Diego. It's always a fantastic treat to be here with the SVI family. I'm myself part of it. I've gone through the program, and you certainly helped us, my wife and I, kick off our real estate investment career. I believe now we have a total of 5 properties, including our homestead. We have 2 international properties. We have 3 homes here in the USA. We're having 2 more built internationally, and we're hoping to get started here with local investing again. We're actually looking into some commercial stuff now. So StratiVentures certainly marks lives and sets the course for people that are serious about real estate investing. So thank you for having me. Thank you for inviting me. I've got a lot of cool stuff to go over with y'all. I know you're going to be tempted to ask questions, so hold them all off until the end so we can make sure to cover all the information and get some really good juicy questions going here towards the end. Thank you for the wonderful introduction. I think you pretty much hit most of the points, Diego. If I were to add anything, it would just be that I've been in the lending business for over 23 years. I started my career early on in banking, and very few people know this, but I actually met Diego Melo while we were working at Bank United in the late 90s. At that point, interest rates were like at middle of 8%, 8.5, I think was prime rate at that point. And in my presentation, we'll see that that wasn't even the worst interest rate environment in history, right? So I know we tend to gripe and complain and moan a lot about rates, but we're actually not in the worst interest rate environment that we've ever been. Maybe the worst that many of us have seen in our home buying, potential years. What else? So my specialization is in conventional FHA, VA loans, rate and term refinances, cash out refinances, and non-qualified mortgages, or your non-standard type mortgages. It's very important to understand that in the lending world, you have traditional type lenders, you have non-traditional type lenders, and then you have private money lenders, private money and hard money lenders. We all fill a space within the financing of real estate in the United States. And it's very important to understand who does what, so that depending on the project you have in mind, you go to the right source, right? So conventional loans, for just to deepen a little bit, and what that means is the type of loans that yield the lowest interest rates, and therefore they're highly pursued. People want to qualify for a normal conventional loan just because it's going to yield the lowest interest rates. And we'll go over those rates in this presentation. FHA, VA loans, government-backed loans, those are for owners specifically that are going to occupy the property that they're living in or that they want to live in. They're not investor type loans. And some of the perks is they provide opportunities that conventional loans don't: lower credit scores, lower assets, lower down payments sometimes. For example, VA loans, a veteran of the U.S. forces, military forces, can get a loan with 0% down, which is not to be confused with like no money at all, right? Because I think a lot of times the industry confuses the consumer in saying no money down, and people think, oh, I don't need any money at all to buy a house. That's never the case, right? You always need to be able to have money to cover closing costs, or at least budget for closing costs in an event that there's no money down required. And then your non-QM loans, your non-qualified mortgages is what it stands for. Those are loans that are given many a times by private mortgage banks. Brokers deal a lot in that world. Essentially, it's loans designed for folks that cannot meet the ultimate conventional loan test or government loan test. For example, a lot of business owners qualify for these types of loans. We look at alternative type of income or alternative type of documentation to arrive at the income that we're going to take into account to qualify a home buyer of this type. That falls in line with like a lot of investors, right, that aren't able to document their income tax. They don't, they're not able to show all of the income that they get from their businesses, from their rentals. So a lot of investors fall into this non-QM, non-qualified mortgage category. So it's really important. Rates are usually higher on those. However, they do require a lot less documentation than a traditional mortgage. And then of course, the down payments are usually higher. So it's one for the other, right? The risk on these is a lot higher. So it's made up by requiring buyers to have higher down payments. And so let's dive in to the market conditions. You ready? So understanding where we're at, current market conditions, and what's driving all this craziness, right? So inflation's at a 40-year high. Currently right now it's tipping around 6%, whereas the target Fed rate is to be about 2.5%, no more than 3%. So imagine we're at triple the amount of, or we're triple at the rate of inflation that the government would like to see the US in. And so of course, that's creating a lot of challenges. Really the only tool in the tool belt of tools that the Fed has to fight or combat inflation, interest rate is probably like the biggest one, right? And so that's what they're going to manipulate the most when they need to get when they need to get inflation down, or at least try to get it down, or they need to speed up the economy, then they're going to lower the interest rates. And that's why you see them go up and down mainly, is the government's effort to either speed up economy or slow down economy, like we're seeing now, right? Inflation has actually been, this year, it's actually accelerated since March, when all the tampering with rates started. So that led to last month's 3/4 interest rate rise, which was very shocking, right? I think that stopped a lot of people on their tracks, a lot of companies on their tracks. The Fed's scheduled to speak this week again on Wednesday, and there's high probability and speculation that they might even raise it another 0.75%. So essentially, what they're just trying to do is they're trying to lower it to bring down prices, bring down the inflation, and not let it get away from us, because it's pretty contagious, right? Once you let it run rampant, it could really get out of control very fast. And then the other thing fueling some of this is that job growth has not stopped. Job growth has actually kept increasing and above what expected job creation rates are supposed to be. It's breaking forecasts. So we're just running at a very fast pace, very strong bullish economical market, and so the Fed is trying to get it under control. That's, in essence, it's not a bad thing. It's just a painful thing, right? Just like when we need to take medicine for anything, it's painful. It doesn't taste good. So what is all this stuff doing for interest rates? I think it's really important for us to understand, and we're going to go over this. If you're a real estate investor or real estate professional, it's extremely important to understand the behavior of rates, when it happens, and how it happens, and understanding historically the historical events that have happened and how they've affected rates. I think that's extremely important, Diego, just to understand and take advantage of the opportunities that are created when we see those patterns occur. Even more important, to forecast future market downturns to protect us from slipping up and making bad investments or bad real estate moves, right? So to go into all of this, I wanted to share a little historical of mortgage rates, and what it's actually done over the last decades. To do this, team, I'm going to show you this. However, I do want to amplify this data. So if you give me just one moment, I'm going to bring up another screen. And Diego, tell me if you could see my expanded mortgage chart, mortgage rate chart. Yeah. Okay, cool. So here's what we're looking at. 30-year interest rate mortgages are in the red, and then your 15-year blue is your 15-year rate mortgage. And we'll see, you know, worst case we've seen in a long time. Back in 1981, the prime rate was at 18%, 18.28 on October 2nd, 1981. Notice that it's dropped ever since, obviously, right? What led to this out of control interest rate environment was a lot of things that happened in the 1970s. There was a lot of government spending, a lot of subsidy and welfare programs that were introduced into the market that were really not that necessary. And then oil prices skyrocketed. So it was a combination of things which, can you please go? Sorry guys, my child keeps trying to get my attention. So 18% rates. Imagine that. Imagine what would happen in today's environment if we went to 18% rates. Okay, having said that, or having kept that in mind, if the Fed keeps increasing rates, we're possibly going to see rates in the 8% range by the end of this year. Okay, so as you can tell, it's never been that high. And then I want to show y'all, back in the 1990s, yeah, late 80s, 90s, we start seeing a decrease in interest rates, which lasts quite a while. 2000s, we go even deeper. So since then, the rates have just kept diving down and down. And of course, we have fluctuations, right? They go up, they go down. So this is really important to understand. Rates go up and down constantly. So if somebody is to get into a mortgage nowadays at a higher interest rate, it's really important to understand that you're not going to be married to that rate for the rest of your life. You're not going to be married to that rate for 30 years, even if you get a 30-year mortgage. You're more or less dating the rate. You're marrying the house. And with that in mind, if the opportunity arises itself, if the cash flow on the property is enough to cover the mortgage, it is a good investment. It's a move forward type situation. I see so many people get freaked out by rates where they're at now, right? But more importantly is, can you cash flow? Can you make money on this deal, even at a 6%, 7%, 8% interest rate? Because history has shown us that no matter what the market is doing, somebody's always going to make money, right? And then if we notice, if we take the chart way back here, November 2021, after COVID, rates really really took a nosedive into low twos. Yeah, I think 30-year rates were in the low twos in January of 2021, January 2021, lowest ever that you've seen in this entire chart that's got over 50 years or so in it. Okay, so let's go back to the presentation. So where are we at right now, right? If you want to know where current mortgage rates are for a 30-year mortgage on a $300,000 home, if you do a 20% down, have a credit score of up to 759, your 30-year mortgage is at about 6% today. This could change, of course, on Wednesday. Your 15-year mortgage is about 5.2, and your 10-year ARMs somewhere around 5.86%. And I'll make a stop real quick here to talk about this, because I should say, adjustable rate mortgages, which are a very scary financial tool because of what happened, back in 2008, the real estate bust. They took a really bad rap, a really scary connotation to it. They actually have a place in the market. Whenever interest rates are increasingly very rapidly or at high rates, they usually offer an alternative to finance at a lower amount. And you get to start off with a fixed rate period, right? It could be 3 years, 5 years, 7 years, 10 years. My recommendation to investors is don't do less than 5 years. That gives you enough time to go through at least one cycle, which will allow one interest rate cycle that will allow you to get out of that and into a permanent or 30-year, 15-year, 20-year mortgage, whatever it is. What we're seeing right now, though, is that the market's really not favoring adjustable rate mortgages. Therefore, you almost see that the 30-year is almost the same as an adjustable rate mortgage. And for the difference, it's really, it's kind of like get the most bang for your buck, right? There's not enough security or protection there on an adjustable rate mortgage yet to justify it. So 30-year mortgages still seem to be the favorite choice of consumers to finance long-term real estate. Yeah. So we're going to dive into property values. We're going to dive into some really important questioning, which is, is this a good time to buy real estate?
And Julian, let me stop you there for one quick second. We
Sure.
had somebody say, I can't see the screen. I mean, we're
Oh
able to,
gosh.
no, you're good. Don't do anything yet. We're able to
Okay.
see it. So this might just be an isolated. If somebody other than who sent this message in, if you can chime in and say, just give us a heads up that you can see the screen, we'll know that it was, that it's isolated, if you don't mind. We'd greatly appreciate that. All right, we got thumbs up, guys. All right, go ahead. It's
Okay.
more of an isolated user. Thanks.
So we should have a chart up that says history of home prices,
Correct.
medium sale home prices sold in the United States. All right, well, cool. Let's take a fun trip back in time when homes used to be affordable. Who would like to go there? I say that jokingly, team, because I know it seems like home prices are like a runaway train, right? So I ran this really interesting analysis. So I wanted to look and see, like, how long has it taken homes to appraise over $100,000 in the United States? And what we're gonna see is pretty surprising. And I think it tells a lot to where we're going to keep going and answer the question that many, many, many of us have, which is, is this a good time to buy? Should I get into real estate now? Should I wait? Should I wait until prices tank so I can get into it, right? So in the late 80s, the median home price in the United States, and of course, this is all across the United States, mixing it all up, right? In Q2 of about 1989, we see that homes were right around 100,000, right? A little bit over 100,000. It'll take until 2004 when home prices are raised to about 100,000. So I'm sorry, 15 years. It's 15 years for home prices to go up 100,000. And then what we see is the next 100,000. It's going to be about 13 years. So Q2 of 2017 is when we see that we're now at about 100,000 from where we were the previous year. Yeah. So it took 15 years to go 100,000, then another 13 years to go another 100,000. And since Q2 of 2017 until now, home prices have gone up, more than 100,000. So that's about a 5-year time span that we've seen an amazing appreciation appreciation market. And then if we notice closely, it was Q2 of 2020, which is when COVID hit, if y'all remember, that exploded home appreciation values. What does this teach us? It's really important. It's so interesting. A lot of elements are in play, right? there was a lot of money. There was a lot of money available during that time. But for the most part, the biggest drivers were low interest rates, which made it very affordable to buy houses. And therefore, many buyers came on the scene. Number two, um, everything halted for about 3 months. So there was 3 months when there was no houses getting built. There was 3 months where there was very few houses getting sold. There were 3 months where people didn't know what the heck was going to happen. And then all of a sudden the gates open, the floodgates open, and everybody came out to buy homes. But we lost a great deal of natural inventory during this time, of course, because that's an entire quarter, right? 3 months is like an entire quarter of production. It certainly hinders real estate sales when you have these situations like bottling up. Now, the other thing too that really hit the scene with all of this was the ability of people to work remotely. So that created an entirely new level of demand for housing that we had never seen before, right? Now, that taught us that we can work in many different ways in many different places. And so that's not going to stop. Like, we're not going to go back to be a society where we all go to the office the way we used to before COVID, for the most part, right? The demand, or I should say the supply or the inventory supply for housing is still not there. It still hasn't caught up. I think prices will definitely slow down and the prices will soften up, but we're not going to see a 20% drop like we did back in 2007 to this is the real estate bust. Y'all remember the subprime real estate bust? 257. We dropped all the way down to 208. I think I did the math on that. It was about a 20% drop in appreciation values. We're not going to go there this time. So we're not going to see prices of homes plummet the way they did, whatever that was 20 years ago or 15, 17 years ago when that occurred. So what does that teach us? That as long as the forces, the economical forces, I should say, the market forces keep playing towards home ownership, people are going to keep demanding houses, and we're far from being able to get away from that. There's certain parts of the country that are going to definitely do better than others. Texas is an amazing market. It's held pretty steadily in the real estate wise since 1987, since the oil crash of 1987. And the job creation, very important to understand. People follow jobs. Wherever there are jobs, there is going to be people showing up. Wherever there's no jobs, people are going to leave and flood out. So I think that's incredibly important to understand when considering house valuations in Texas or in any state where you have these healthy economic tendencies. So, for example, the home prices rapidly rising, mortgage rates discourage potential buyers and cool the market. Yes, interest rates, the way the interest rates are going up, they're meant to cool off the market. They're meant to slow down buyers, which is a good thing. So homes stop appreciating at these out of hand levels, right? It's never good to be a runaway train in anything, right? We've seen that in the stock market. We've seen that in many industries. And what happens is you have pretty nasty crashes that are very, very painful. So it's great when things appreciate quickly and we cash out and make quick buck. But long term, it's just not a sustainable strategy. So it's not healthy in the long run. But as long as jobs are being created, people are going to keep coming to Texas. People are going to keep going to Idaho. People are going to keep going to Las Vegas, Nevada. People are going to go where the jobs are at and home prices are affordable. So if you're in that market, I would say you're in a great place. And if you're not in that market, then go look for that place where you can find homes that are of high demand. I like to think, Diego, that working class family type rentals are always safe and secure. Because we want to, my wife and I want to have our investments where where we have the biggest pool of renters available to us, right? Whatever that is. Anyhow, recording house prices, employment levels, as long as we see those strong, I think we're going to see valuations remain. Again, it might soften up, but we're certainly not going to, we're not going to get 20% derail or anything like that, Diego. And with that, I think we can open it up for some questions and
Okay.
answers.
Awesome. And
Yes.
Julian, one question for somebody that's a new real estate investor and obviously thinking that one of the exit strategies is not just a purchase, renovate, and sale. It's more
Mhm.
of keeping it as a passive investment. If you could give them a little bit of advice, how to set themselves up paperwork wise for when they're presenting themselves for a long-term mortgage, what would you say? Because I mean, long-term leverage is the best way to go.
Of
Best
course.
rates, length of time. So, what would you recommend be their first things to do to setting themselves up?
That's a great question, and so many people try to dive into it without really knowing what their, possibilities are, without really knowing what they're going to qualify for. I would say the first thing anybody that's on this call that wants to become a long-term investor, like a holding type investor, should get qualified for a mortgage up front. Find out from a lender, okay, if I buy an investment property and I'm going to hold it, can I afford it? Like, will you approve me for a mortgage, right? And give them an opportunity to let you know what type of mortgage you could qualify for. Or if you don't qualify for the mortgage, then at least you'll get an assessment of what you need to do in order to get to a point where you do qualify. And remember, there's different types of mortgages too, right? It all depends in what you're trying to accomplish and the kind of loan that you're trying to qualify for.
And that leads me here to a question that Patrick Harrington asked. And welcome, Patrick. Is the rural market still strong, such as College Station, Navasota, et cetera? And what's your opinion about like a rural base, outside of the general major cities?
I think as long as they're close to major cities, they'll still hold up. If they're not, if they're more vacation type destinations, second home type destinations, I think that's where you may see some of the biggest cool downs. I would think that there has to be something to drive people there past comfort or convenience or destination, lakes, that sort of thing. It really depends. So I would look at that closely. I would look at what is pulling people to that area and find out if that is prone to continue, or will it look like it's gonna slow down or stop.
Excellent. And Patrick, if you're talking about the College Station, Navasota area, and for everybody that doesn't know where that is literally the northwest corridor area of the Houston and surrounding Harris County. And
Mhm.
also that connects to the University of Texas A&M. And that sector has just literally exploded because that's the way towards Austin. So that area is, I mean, there's a town that we were on our way to Fredericksburg, I think here recently, and there's a town called Giddings. And 3 years ago, 4 years ago, Giddings was like two stores were open as you went through it.
Mhm.
It's thriving right now. And so
Yeah,
that's a big indicator, Patrick, that those are strong areas.
correct. I think you hit nail on the head there, Diego. Wherever you see strong, how do I call it, commercial activity, because people look for that, right?
Yeah.
If what drives people to move to these places, I think, in our modern times is the fact that they can live in an isolated place, small place, affordable place, right? But they're going to want to know that they have grocery stores, retail shopping areas, nice cafes and restaurants. So anywhere that I would see something like that, I would imagine that it's going to stay relatively strong for people looking for places like that.
Okay. Jinzi Shu asked, my question is, with higher interest rates suppressing purchasing power, will it drive up rents instead, or first-time home buyers turn to rental? Well, is that going to keep people more into the rental spectrum instead of actually going out to buy a property? What do you think?
I agree. I think it's gonna discourage a lot of people from moving into home ownership right away. Naturally, I think a lot of people just sit and wait. You know, we certainly did that. This is really interesting, Diego. Back in 2019, and as a matter of fact, you gave us the hard hats that we put in the center when we acquired those two rental properties. We were buying rentals at about 140, 150,000. I should say 130, $140,000, right? 3-bedroom rentals, 1,200 to 1,600 square feet. And we thought that they got too expensive when they got to 150,000. Yeah, we're like, oh, we're gonna stop. We're gonna wait. We're gonna wait until they go back down. Well, here it is, 3 years later, those houses in that neighborhood, they're selling for 230, 240. So waiting has costed us $100,000 as an investor, right? Uh, those rentals are performing magnificent. We've raised the rents from where we started like by $500 a month. So as an investor, I think it's a great opportunity, right? Because yes, it's gonna put these high rates are gonna put a lot of people on the bench. And what else are they gonna do? They're gonna rent.
Absolutely. In the investor pool to the traditional mortgages, there's always been this, how would I say this? I love our hard money lenders that we work with. They're
Hmm.
phenomenal. I love our private lenders that we work with. They're phenomenal. When it comes down to knowing that the traditional, agency, Fannie Mae, Freddie Mac type lenders, what is their appetite right now for something like that? I mean, is it more somebody that's doing a second home, or are they more open to the overall investor mentality?
So it's certainly a risk mm, exercise, right? A risk evaluation exercise. So yes, investors are at the highest peak of that investor ladder. Then you have people buying second homes, and then down at the bottom, at lowest risk levels, is home buyers that are looking to live in the house. That's interesting that you touched that point, because that brings me to share with you that as your position is higher on that ladder, you're considered a higher risk borrower, and therefore you're going to pay higher interest rates. We have not seen investor type on loans on the conventional market cease to exist. What we're seeing is that they're more expensive than they normally have been, not just rate wise, but also investors are having to pay a good chunk of points in order to get a mortgage loan, just like you would with like a hard money loan. In some cases you have to pay close to that to obtain a long-term mortgage of this type right now. And I want to share with you guys why that's happening is the interest rate environment is never acceptable, right? Never acceptable. So the forces of nature are going to want to force rates to go back down, right? I mean, essentially the Fed wants to do that because they want to keep the economy at a steady pace. They want to slow it down just enough so that it can go back, get it under control, and then have it move where the middle class America is thriving and well alive and affording a nice healthy life, right? Consuming. So in order to do so, um, at some point the rates have to come back down. They have to come back down to rates where it encourages people to shop at homes and borrow and make capital investments and things as such. Um, and so when that happens, what we're going to have is another refinance boom, another huge refinance boom. Um, and I forgot what the original question was, Diego, but I was going somewhere with all that.
Well, basically was stating that, if somebody's lending money to an investor, primarily a lot of the people that are joining us today, is that they're going to get a hard money loan, and that is basically
Hmm. Of
there's a purpose and a reason for hard money loans.
course.
It's speed, leverage, accessibility. Let's get this closed as fast as possible, because I love to say a good deal doesn't last long. And then we also have to look at the lending partner, which is that hard money lender, is that they don't want to get stuck with an actual property, knowing that that goes inventory. If they have to take it back or they purge it, they can't turn and circulate that money and charge points, because that's literally how they make a lot of money. Is knowing the ability that a takeout lender is going to have the appetite to pull some of the hard money lenders back, right? To repay them. Yeah, that's kind of what I'm asking.
Of course. No, so I think we can sum it up in saying that you can still get a conventional investor type loan. It's just going to be more expensive than it traditionally would. Of course, the rates are going to be higher, but you're going to pay points, whereas in the past you haven't had to.
Are you seeing, and I'll be the first to tell you this, we do use a broker that puts us in with over 100+ non-traditional lenders, and before the rate started moving, we were seeing 4.875 investor 30-year mortgages. So how's that war with you guys right now?
So, earlier this year, I did some people at about 4.5, 4.6% on a 30-year mortgage. Right now, we're seeing rates of over 8% in those non-traditional type, non-QM type mortgages. And I want to add that, our private money brothers, our hard money brothers, our conventional, we're financial tools, right? We hold financial tools to acquire, leverage, and exploit real estate. So whatever the situation is, you just need to be aware how they work and how they're going to help you achieve your goal of investing or your goal of ownership in real estate. You and I talk a lot about hard money loans, right? I'm a conventional money lender, but I'm not shy or scared of hard money loans or private money loans. I know they have a place, for certain transactions. I mean, that they're really the only way on certain transactions. You just have to know that you can get out of it, and you have to know that you're going to have the credit profile to qualify for the lowest long-term conventional financing option that you can find.
And that comes with getting your ducks in a row, the pre-approval process, and finding out whether you're obviously going to meet that takeout loan criteria. And this is how they can get a hold of you. Is that correct, Julian? This is the direct office, direct cell, and your direct email. I know you're a family man. One of the things that I love about you is, you had your kid just walk in there, things like that. You're constantly
he's
around
back
family.
in now.
Yeah, so you're constantly around family. And so what are your hours of operation? When is it a good time for somebody to reach out to you?
We're almost finished, Papa. Give me a moment. Yeah, he's dying for me to get to pay him attention. We're available 8:30 to 5:30. If you have a after 5:30 consult or question you want to run by me, feel free to shoot me a text message. There's my cell phone online on the screen.
Perfect. We've got one more question that came in. Are small local investors being squeezed out by large foreign and domestic institutional investors that are buying up entire neighborhoods to rent, and home builders buying build to rent neighborhoods? I don't see that ending well for affordability. What's your take?
I think they have definitely impacted the inventory levels. However, I also feel that there's always opportunity for all of us that want to invest in real estate. So no, I don't see that as an inhibitor. It's part of it. It's part of the group of investors and competition that we have out there. But I wouldn't let that discourage me from wanting to take part and find opportunities.
That's such a great point there. Before, when I started investing in 2012, we would literally go to the auction, right? Before and literally on the first Tuesday of the month, go check out the auction and actually kind of see opportunities that might fit our model and might fit our risk. Now, I don't see it, for the reasoning being that, yes, that is where the larger pool purchases are coming from. That's where all these larger buying power organizations are coming in there. And that's just the simplicity, guys, that as real estate investors independently, we have something called the cost to value. And that cost to value is what's it going to cost us to what it's worth. And then you have to determine what's called the loan to value, is what is the lender considering what it's worth to what they're going to lend to it. Usually a safe number, guys, what we like to tell everybody at SVI and what we train them with is 75% cost to value should pull you into a good loan to value, which doesn't hurt that much, right? But if you're going into these auctions and buying at an 85, 90% cost to value because the property doesn't need that much repairs, you're not going to be able to compete, guys, against these larger organizations that are coming in there and buying at those larger cost of value numbers, guys. So be very careful. Remember, it all boils back down to how much meat on the bone you have, and a good rule of thumb is about 75%. Julian, this is your full contact information here for people to reach out. Those of you that are still right now, if you got any questions, feel free to jot those down. I mean, go ahead and put those into the chat. We'd be happy to answer those. Any tidbits that you want to let us know before we move into the final part of the presentation?
No, I think on my end, I get a lot of calls from SVI members, especially after we do these sort of events, just wanting to consult and ask me questions, how to get prepared, what do they need to show when applying for a traditional type mortgage. If that's you, feel free to give me a shout. If I'm not readily available, shoot me a text message, and we'll get on the horn and go over it.
Excellent. And you're always a source of great information, and a lot of it is also based on taking action. Guys, want to thank Julian for his time today, and also a lot of our SVI partners and affiliates. Here's a little snapshot of who we work with. And definitely, if you want to know more about StratiVentures, feel free to scan the QR code that you see there. And literally every single one of these vendors, if you tell them you're an SVI member, they're going to know, and then they're definitely going to be happy to work with you. I also want to invite everybody that's joining us that is not an SVI member, go to StratiVentures.com and sign up for a free one-on-one training session in each one of these realms. We'd be happy to talk to you, because that's where we get to talk about us, right? How can we help you? We do deal reviews in these, and everybody who's not an SVI member, ask us about the basics. We just launched the basics and it is awesome. Want to find out, just basically let us know. Go to StratiVentures.com. And I do want to do a couple messages here for everybody that is a real estate agent that is looking to work with investors or learning how to understand how to work with investors. We are holding our Realtor Advantage free trainings in 3 cities. And we have our first one coming up on August 9th here in Houston from 10 in the morning to 1 o'clock in the afternoon at the Quest IRA Training Center. That is Houston. We also have in Dallas the 16th of August in the Quest Trust and IRA Training Center, 10 to 1. And then we have the 23rd of August is going to be in Austin, again, 10 to 1. All that information, guys, is in the StratiVentures.com webpage under events, or in the real estate, the Realtor Advantage tab. You'll find all that information there. It is free, guys. You don't want to pass that up. And by the way, if you are going to join us at those trainings live, we have an amazing incentive there for y'all. So do not pass that up. Getting to know us social media wise, I have to say this because Oriana will kill me. Like and subscribe. You can go to our StratiVentures social media pages and our YouTube channels, and you can see all the past webinars. You'll see this one being loaded on there also, and feel free to call us at the 800-504-2909, or simply just email us at info@strativentures.com. One last, we got two more questions here, if that's cool with you, Julian, so we could close out.
Oh, yeah, absolutely. As long as y'all want to keep asking questions, I'd love to answer them.
Oh, yeah, that's fun, right? That says, how have you heard about lenders closing doors because of the environment? How should we take this?
I think it is a phenomenon of right sizing the market. During the incredible low interest rate years after COVID, lenders hired massively to try and handle the unbelievable volumes of loans that were available. Um, Now the market is at 50% capacity, 50% of what we're used to doing. We're seeing that in the leads in our office. So we're just a reflection of the market. So um, lenders are having to get rid of a lot of people. Um, the interest rate environment certainly is pretty hostile to some lenders, and some are having to close their doors. Um, I think in general there's still a good, healthy pool of lenders across the nation, um, but we're all having to adjust and right size our businesses.
Correct.
Um,
What, last question here. Will tax lien opportunities be growing with the rapid increase of taxable values and increases in taxes? Patrick, that answer is yes. That absolutely is yes. But please, Patrick, and any of you guys that now see that as a form of opportunity, you've got your short sales and you've got modifications and you've got tax lien issues. Feel free to give us a call. We'd love to give you some insight because we've purchased properties in every single one of those avenues, because not everything is hunky-dory, right? It's not easy. There's a lot of things and nuances that come with every single one of those opportunities. So for everybody that's joining us this evening, I really want to thank y'all for attending. We really love the fact that you took your Monday evening and spent it with us. And Julie, I want to thank you and the Altera family, especially your family, for being great at SVI. And
thank you.
let's ramp up those rental properties for you. Let's double it this year, my friend.
We need to. We're
Yep,
ready.
yep. And remember, don't forget, we've talked about new construction, my friend. I need you to get on that action plan to get your new builds moving.
Yes, sir. That's what's in our scope right now.
Yep. Awesome. All right, everybody. Thank you so much for joining us this evening. We really appreciate your
Thank
time.
you, guys.
StratiVentures.com, be able to see the next webinars that are coming. Take a look at us at the landing page, the StratiVentures.com, and sign up for your free one-on-ones. And don't forget, if you're a realtor, go to the live Realtor Advantages in either of the cities, Houston, Dallas, or Austin in the month of August. And by the way, Julian, we have them happening every month afterwards on that Tuesday.
Yeah, we need to team up about getting a real estate community out there. I already signed up for the one coming up, by the way.
Yeah.
So anybody
Oriana's gonna she guarantee you she's already made notes. She's gonna answer your phone. Okay. All right, guys. Everybody have a great evening. Thank you for
all.
stopping by.
Have a great night. You guys enjoy. Happy investing.